With that in mind, let's bring in Wall Street Alliance Group partner Aadil Zaman. Aadil, first of all, let's just talk about this market, the narratives, because they seem to change almost daily. One day, yesterday, we were euphoric, at least the market was, the consumer was strong, and today, oh man, not so sure. Retail is the worst performing sector outside of technology today. So day to day, the narrative changes. How are you keeping up?
Well, we think long-term we are constructive on the market, but, and the Fed has vanquished inflation, so that part is sorted. But the market has gone up so much in such a short period of time, so a correction would definitely be on the cards. I think what the market is going to be especially sensitive to is anything negative when it comes to the consumer, because about 68% of our GDP is consumption. We could pull back, and that's what we are seeing today.
So let's talk another risk I know you like, that something that's been bothering you is the concentration, right? The Mag 7 have been such a dominant force. At some point, 36% of the market. Maybe that's starting to change here this quarter. So do you see this, the shifting of the guards, as an opportunity? Some think, well, if the Mag 7 don't lead, that means the overall market's going to go down.
I think the biggest risk in the market is market concentration, right? If you add back Meta and Alphabet, around 40% of the S&P 500 is tech-related companies. 3 stocks comprise more than 20% of the S&P 500. So a lot of the investors are very concentrated in their portfolios right now, and they should use this rally to scale back a little bit, make sure not more than 5% is in any individual stock, and diversify into other sectors that have been lagging, and that could benefit potentially from rate cuts.
All right. So you're really talking portfolio management, and that's always the case then, right? I mean, no matter what. So you are essentially, that forces you to take profits on your winners, to not be overloaded, and to always have sort of a balanced portfolio. I bring that up because the last time you were on, you talked constructively about utilities. By the way, no one was really talking constructively about utilities, and look at this. This has been one heck of a run. This is through the summer. They're killing it right now. So is this an area that it's traditionally defensive? Would you stay in there? Would you add to it here?
I'm glad you pointed that out, Charles. That was a great call the last time I was on the show.
If you may say so yourself.
If I may say so myself. That's it. And no one's talking about it. I mean, it's a boring sector, right? Worst performing sector last year. We think this has legs. It has become one of the best performing sector. And artificial intelligence consumes a lot of electricity. They will do well because of that. They also pay dividends, and dividend is going to be a continued theme for the future.
That is really amazing because, listen, I was in the utilities, particularly next there, got out, wasn't moving. Then we got back. We got a couple of utilities now. To your point, though, the electricity crisis should do them well, and they pay a really fat dividend. I can't let you go. We're looking at some of the long ideas. We got a minute to go. I won't say it's eclectic, but you've got themes behind all of these, including Pfizer and this new longevity thing that's going around.
Yeah, so I think healthcare, people are living longer, so I think that space is going to grow. I think the breadth in the market is going to improve, so healthcare is going to do well. Pfizer pays a dividend of about more than 5% and is relatively flat for the year, so there's opportunities there. We also like the financials. We think that the banking sector with rate cuts, investment banking activity should pick up.
Is JP Morgan best in breed in your mind?
We think that's the best in breed, trades at relatively low valuation, pays a very good dividend. We like that story.
ExxonMobil, West Texas Intermediate, pulling back here a little bit. I know it's a dividend player, and that's one of the themes that you keep that's recurring in this piece here. Long term, though, you like ExxonMobil here?
Yeah, we love ExxonMobil because, geopolitical tensions, even though right now oil is down because of the China news, but geopolitical tensions will drive up oil prices in our estimates. And Exxon's break-even on oil is much lower than what oil is even trading at right now. Pays a good dividend, trades at relatively good valuations. We like it.
And you're buying the gold breakout. You like GLD?
We love GLD. We have it in a lot of our clients' portfolios because gold works out in various different ways, right? There's volatility, gold does well. Market goes down, gold does well. Fed cuts rates, dollar becomes weaker, gold becomes stronger. So I think GLD has done phenomenally this year. I think it continues to do well.
All right, Dill, you're killing it. Thank you very much. Appreciate it.
Thank you.